to the video. Today I want to show you how you can improve your market timing with a very simple trick. So not everybody is a member of my community or watched my video course. So in the member community and also in the video course, you learn how to time the market with a lot of different indicators. So like the trend following indicator MMTS, what we are using, like net highs, net lows, and also we watch the number of stocks above the MA200. But it must not be so complex. So when you don't have the access to my member community and video course, then you can use a very simple timing tool, and this is a moving average, and especially the moving average 21. So we can have a look here at the indicator. You can see I use moving average 8, 21, 65 and 200. The moving average 8 is right now not shown in the chart, so I don't look at it all the time. And I will also hide the other ones and just look at the EMA number 2, which is the EMA 21. And that is a very, very simple timing tool to time your stock buys better. Because it is a very simple way to look at the moving average 21 and say, okay, if the Nasdaq composite, so the broader Nasdaq index, is above the EMA 21, above the green line, so that's the case here, and that's the case here, and that's the case here, and of course here all the time, then it's time to buy stocks or to look for new buys. When the Nasdaq composite trades below the EMA 21, so that's the case here, for example, just for 3 days, but that's also the case here, and if you look back a little bit, that's the case here and here, for example, then it's time not to buy new positions, to wait a little bit, to be more selective when it comes to new trades. And this is a very, very simple way, because if the price of the Nasdaq and other indices drops below the EMA 21, that means the price is falling and there is distribution and selling in the market. And you don't want to trade against the market. You want to trade with the market. And that's the reason why you can use moving averages as a very simple timing tool. And why the moving average 21 and not the moving average 65 or 200? It depends a little bit on your strategy. So I am a mid-term position trader. That means I usually hold positions for a couple of weeks to months when I'm in a profitable good trade. So and the EMA 21, I think it's a very good compromise between long-term and short-term. The EMA 8 would be too short, the EMA 65 would be too long, and I would give back too much profits. And that's why I think the EMA 21 is a very good indicator for mid-term position traders. Of course, and this is important, it's not a perfect timing indicator. So you can see that every trend follower or every trend following indicator has problems if the market goes sideways, like here, for example. So it dips below the EMA 21 for just a couple of days or just 1, 2, 3 days and so on. And in that time, you will get wrong signals. That's absolutely normal. No indicator is perfect and no indicator works all the time. But the indicator EMA 21 here helps you to stay in the right market situation. That means on the long side in a very clear trend. So that means in the last couple of weeks here, since beginning of May, you were positioned on the long side and you were looking for new long trades instead of exiting trades or being in cash or something like that. And as soon as the price drops below the EMA 21 here, you stop looking for new trades. You stop buying new positions and you wait until the market is back in a short-term uptrend. And I want to give you another tip, and that is the angle of the or the slope of the moving average 21. So let's hide the price for a second here. So, or maybe just I'm not sure if I can hide the price here, but maybe let's really only look at the slope of the moving average. So you can see that the slope of the moving average sometimes goes sideways. That's the case here, for example. So it's more or less going sideways and slightly down. So that signals you a very clear short-term sideways trend. It's the same thing here. But as soon as the slope of the EMA 21 is moving up again, the market is in a much better shape. And here you can see it's turning around. It's clearly turning around. And that gives you a very clear signal to maybe don't buy any stocks right now. And if we zoom a little bit out and go back in time, which I always recommend to students of my video course and also in the member community, to study past times to learn more about the market. And you can see that the EMA 21 trend were in a downtrend here and then turned around, and the price were moving back above the EMA 21, and then the slope was up, and that here was also a profitable market period beginning of 2023. And when you look here at the market period from October to December here, you can see that the slope of the moving average was not flat, but it was not so steep as you can see here. And that's a very clear sign, because the prices went sideways here more or less, and there was not enough momentum in the market, and that's the reason why the moving average was more or less going sideways here. And even in the bear market here in 2022, this one helps you a lot to be out of the market or not look for new buys for a long period of time, because you had very clear downtrends here, and a lot of the time the price were below the moving average 21. So it helped you to be out of the market and also to get back a little bit into the market when you had a very clear uptrend. So, and you don't have to buy anything only because the price moves above the EMA 21 just for 1 day or 2 days or something like that. Instead, you want to set yourself back into a buy mode in that situation, open your eyes and look for new potential long trades in your watch list, but you don't want to buy anything in that case. So you maybe set yourself back into a buying mindset when the price is moving back above the EMA 21, and then when you have a very clear uptrend with the slope of the moving average, in that situation you maybe find more great setups on your watch list, and then you are ready to buy. But you need such a simple indicator to really help you to time your buys correctly in the market. And when we go back in time a little bit more, so maybe going back to the big bull market here in 2022, you can see how long this indicator helped you to stay in a buy mode, so for a couple of months here, and also to get you back into the market or into a buy mode very early. So after we had this significant correction here in the market, it gave you a very, very early buy signal. And yes, as I said, it's not perfect. You get a lot of wrong signals here in a sideways market period. But then after that, you were able to have a more or a longer trend here in the market. And then you are in the right mode to buy new stocks. And you can go back in time for years, and you can see that the EMA 21 was a very helpful timing indicator to time your buys in the stock market much better. Of course, again, it can become very choppy if the market is choppy, but usually in a choppy period, in the market, you don't have so many great setups on your watch list, and then you maybe get a buy signal from the market itself, but there is nothing to do, there is nothing to buy on your watch list. And this indicator just help you to be on the right side of the market and time your buys a little bit better. But it's not replacing the buy signals from the stocks on your watch list. So if you go back in time, you can see, especially in clear trend periods, this indicator helps you to stay in the market and stay on the right side. But if we look at 2015 here, for example, which was a very, very difficult trading period because the market was going sideways all the time, you get a lot of wrong signals. But in that case, it helps you to stay on the right side if you look at the slope, because you can see that the slope of the moving average isn't very steep at the time, so it's more or less going sideways. And when you see that, when you see that the slope is always going sideways and then have a negative slope again and just an upward slope for a couple of days, then you know that you are more in a choppy market. So, and years ago, I read a book about technical analysis, or just a part of a book of technical analysis. And the author highlighted how important the slope of the moving average is, and not so much if the price is above or below. So the slope of the moving average, the downslope or the upslope, is much more important than if the price is above or below, or if you have cross of moving average or whatever. So to sum it up again, you can have a very simple timing indicator for the stock market if you look at the moving average 21 with a Nasdaq composite together. If the price is clearly above the moving average 21, you should look for new long trades. That means to buy anything. If the price is below the moving average 21, you should stop looking for new buys and stop taking new trades. If the slope of the moving average is clearly going up in a steep angle, you are in a strong uptrend and you want to be a little bit more aggressive and looking maybe for more new trades to buy. If the slope is down, of course, you should not buy anything. If the slope is going sideways and the price is breaking out, so moving back above the EMA 21 here, so be a little bit more careful. If the slope is turning around and going or start to go sideways after it moved up for a while, you should also become more cautious. So the slope is really important. That is one of the magic tools to look for the right signals. Again, in the market update community and also in the video course, you learn much more about market timing, and we use some additional indicators as I showed you at the beginning. This is very, very helpful to get more and better signals from the market and help you to position yourself on the right side of the market and reduce exposure at the right time. But I think that this very, very simple indicator and market timing technique can really, really help you. And if the most traders would use that, I'm very sure that they would have much better results. All right, I hope that this video helped you to understand this very simple timing technique. So if you have any feedback or comments, you can use the comment functionality here in YouTube. You can follow me, of course, on every social channel if you want to. You can subscribe to my free newsletter I send out every Sunday with a lot of trading tips and stock analysis. And if you are interested, you can try out my member community 14 days for free.